Welcome, everybody. I can see people are starting to trickle in right now, so I'm just going to wait for maybe like a minute more, and then we can get started. Okay, so I know people are still joining us, but since it's 6 o'clock here where we are, I'm going to go ahead and start. Hi, everyone. Thank you so much for joining us, and welcome to KPIs Every Financial Controller and FP&A Should Master. I am Helen from Beebole, and I'm going to just start things off and do some introductions, okay, as people continue to join. I know there was some confusion about the time, and it seems like not everybody received the correction email that was sent out, so we really apologize for that. The good news is that we're recording, and the video is going to be shared afterwards with everyone who registered, so if you have to pop out early, no worries, okay? We are very excited to have Paul Barnhurst here hosting the webinar today. If you work in finance, you very already likely know of Paul. He's a finance expert, a thought leader, a podcast host, and he is the founder of the FP&A Guy. And he has a lot of real life experience in a range of industries, from government to automotive to e-commerce and much more. So before Paul takes over, I also just want to very quickly mention our sponsors, the Data Rails and Personav. Data Rails is a financial planning and analysis platform for Excel users. So some of you are probably already using it, and it automates data consolidation, reporting, and planning, while also enabling teams to continue using their own Excel spreadsheets and models. And then Personav, our other sponsor today, delivers custom outsourcing solutions that improve the efficiency of teams by hiring, training, and retaining top talent. And their accounting professionals handle transactional tasks so that clients can really focus on decision-making that prioritizes growth. And finally, of course, I need to mention Beebole. Many of you are already using Beebole. Some of you are Beebole customers, but for those of you who aren't familiar with us, we are an all-in-one cloud solution for employee time tracking. So that could mean project tracking, time and attendance, time off, scheduling, etc. And with Beebole, what you can do is you can track costs, billing across clients and projects, and then you use our integrations with Google Sheets or Excel to link your time and your financial data, or really any other reporting that you might be doing in spreadsheets, all in real time. So that's kind of the end of my spiel. During the webinar, please feel free to include any questions that you have. You can use the chat box or the Q&A tool, and Paul will do his best to address them all at the end of the Q&A section. And also just a note that after the webinar, we're going to be sending an email with Paul's downloadable Excel files with all of the formulas from today. And then also, as I said, a link to the webinar recording itself. So we really hope that you'll share it. I mean, please do share it with friends, colleagues, anyone who you think may find it useful. And we couldn't be happier to have Paul here today to lead this conversation. So without further ado, I'm going to go over and pass the mic over to him.
Thank you, Helen. Really excited to be here and talk with all of you. Thank you for making some time out of your day to attend this. I know for many of you, it's budget season, and I know how busy that time of year can be. So appreciate you carving out an hour, and just really excited to chat with all of you. As she mentioned, this is brought by Beebole, and then we have Data Rails and Personav, and I've been lucky enough to work with all three companies. Data Rails sponsors the podcast I do. I've been on podcast with Personav, and then obviously this opportunity here to work on this webinar. So as you mentioned, just a little bit about me, Paul Barnhurst. Most of you who are on LinkedIn would know me as the FP&A guy. I did an MBA and a Master of Science in Information Management. Spent 12 years in corporate FP&A, primarily business unit support, mostly working to support the business. Run my own podcast called FP&A Today, do daily content. And today I'm just really excited to talk about KPIs. And as you know, the title, as we see here, KPIs every finance controller and FP&A professional should master. The secret is there are metrics that we should all know, but which KPIs we use will be unique to each business. So I'll let you in on that little secret. But what I want to do is we first get started. Before I even show this, I just want to actually if people can put in the chat, I'm going to ask a question here and just try to answer it. If you were to Google the phrase metrics, how many hits do you think you'd get on Google? Do you get 1 million, 10 million, 100 million? Anyone have any guess? Just put it in the chat. 1 billion. All right. Anyone else? Thank you, Jonathan. We'll see if anyone else has a guess. 15 billion, Miguel. 2.5 million from PJ. Anyone else? We got Duty with 1 billion. So the number I got this morning when I typed in metrics, I tested this to see what I get, was 1.2 billion. So those who put billion are closest. And so it just speaks to just the sheer amount of data we have out there. You know, here, this is a dashboard I love, a cartoon, right? You see the guy is like, look, our new dashboard has all the different KPIs we can track now, and you can see everything imaginable. And I love the lady here. What's that KPI trending to 0? And you'll see it down here in the bottom. And it measures how well we understand them all. And I'm guessing anyone who's been involved in selecting KPIs, building dashboards, has probably experienced something similar to this. Maybe not, you know, to this extreme, but that information overload. I still remember in my career one time, we were sitting down with another finance professional I worked with and one of our general managers, and we were having a meeting about what are all the metrics we should be tracking. And we were calling them KPIs, and we kept getting more and more added to this list. And I remember thinking, okay, 1, the company, we have bad data. 2, we're not very good at tracking things today. And 3, how can these be key? How are these really important if we have like 100 of these? And that was really a learning moment for me about KPIs. And that project was a learning moment because it failed. Yeah, we got a few metrics tracked, but we never tracked what was on that list. And we were never able to really focus and bring it down and distill it to what was important. So that taught me a lot. The second thing I want to emphasize, I think this dashboard emphasizes, and we talked about a little bit with that 1.2 billion number, is just the sheer amount of data that we have in the world today. It's really easy to get caught up with data overload and to try to track everything. And what was fascinating is I was doing some research about the amount of data we have today. And what they said in 2022 alone, we will track 94 zettabytes of data. That's how much we'll create. So that's 94 with 21 zeros, right? You hear about gigabytes. Sometimes you hear about a terabyte or a petabyte. I didn't even know a zettabyte existed till I researched that. The other thing that's really interesting is the amount of information doubles every 2 years. And I just think that's astounding. You think of all the information that's been created worldwide in the history of the world, and we're at a point where we double it every 2 years. So it just speaks to how much data we have and the challenges in managing it. So what I want to start with is, as we talk of data, sometimes we'll hear the term metrics and KPIs, and sometimes they'll be used interchangeably. The way I like to think of it is all KPIs are metrics, but not all metrics are KPIs. So the KPI is really your critical or key indicators of progress toward an intended result, as it says, right? It's something that you can quantifiably measure that helps with long-term performance. So, you know, some examples could be if you're talking about a customer KPI. People have heard of Net Promoter Score. You know, what's your customer satisfaction? That's something that would be critical and key to understand. You know, it could be complaints logged on a daily basis, depending on your business. Maybe it's a daily efficiency for a shop. It could be a financial metric, right? It can be a number of different things of those key performance indicators and in different areas of the business. Well, we're going to talk a little bit about metrics, and then we'll focus down to those finance metrics for this, you know, presentation. But all KPIs can come from all different parts of the business. But the key thing to remember is they really have to be critical. An example I like to give, you know, if I'm trying to lose weight, which I have been over the last year, you know, there are going to be key things I'm going to track. You know, how much I sleep at night probably isn't going to be top of my list. It's going to be, am I exercising regularly? How am I eating? You know, it's am I getting up and moving around frequently? There might be 2 or 3 key things that I really look at, which is probably going to be, am I exercising and how much am I eating? Other things beyond that might just be metrics. I could track them, but they're not key to driving the result I want to achieve. And so that's really how I like to think of KPIs. And where that starts, before you can get to the point where you're tracking those key metrics, is you really need a data-driven culture. And again, I love this Dogbert cartoon here. I mean, I imagine we have a few Dilbert fans. Feel free to, you know, put your hand up in the chat there if you're a big Dilbert fan. I know I am. So here we have Dogbert, which is one of my favorite, the consultant, right? He says, you need a dashboard application to track your key metrics. Pointy-haired boss, right? Is standing there looking at him like, well, what's this all about? That way you'll have more data to ignore when you make your decisions based on company politics. Will that data be accurate? Okay, let's pretend that matters. I'm guessing anyone who's worked in corporate America has seen decisions made off politics, right? I see the laughing, crying emoji coming up on my screen there, right? We've all been there. I know I have, where people just ignore the data. They're like, who cares about the data? It's about company politics. Well, a data-driven culture helps change that. And what's interesting is many of you have probably heard the term digital transformation. We've been hearing it for a decade now. And it's that whole idea of, hey, we need to transform our system, be more digitally based, move forward, be data smart. Harvard Business Review did a study and said the technology is not the hardest part of the transformation. The technology is just the enabler. Where you come up with a data-driven culture and make the change is changing the culture. That's the hardest part. And so a culture that is data-driven, a few things you see. There's a source of truth, not 10 sources of truth that don't match. Your employees are empowered to make decisions with data. They understand what the key metrics are. They have access to the data. And where the magic really happens is when you have a data-driven culture and everybody knows what the KPIs are and they're able to influence them, you can accomplish great things. Multiple studies have shown data-driven cultures have higher revenue growth and higher margins on average than their competitor, their peer set, right? So obviously that's going to vary by industry. It doesn't mean you're going to have the best numbers necessarily out there, but you will perform better than your peer set. So that's really one of the first things that's critical to getting to that point of really being able to measure what matters and focusing on what is important is that data-driven culture. And that starts with leadership. It starts at the top. It starts with change management and then willing to make the investments for the tools to help enable it once the culture and the change management is in place. So we're going to go, if we go here, next comes, okay, so we have the data. Now we have to measure it, right? So often we don't measure regularly what's important, kind of hit and miss on reports. And the way I like to think of the importance of measuring is think of your own life. Go back to, when you started kindergarten or started school, you probably took a test. They measured where you were at. Often when you start different classes, you take a pre-test. When you're born, one of the very first things they do, I remember when my baby daughter was born, one of the first things they did is they weighed her and they measured her height. Measuring is a key part of society. And when it comes to business and success, it's really critical. I love what Peter Drucker said, the famous organizational management guru. He said, if you can't measure it, you can't improve it, right? How can you know if you've done better than something if you don't have a measuring stick to start with? Like, I'm a runner. I've done a lot of running over my life and, right, we record the time. If I don't have the time for my last race, how can I know if I'm improving, if I'm doing better or not? So, just want to emphasize that importance of measuring. Even think of sports, music, all these different things. We have ways to measure them. And so that gets us to KPIs. With measurement comes a tendency, like I said earlier, to over measure. Over tracking and measuring is a real problem. So I'm a big sports fan. So I found some interesting statistics around sports. I hope some of you out there enjoy sports from the audience. So I looked at in the US, the major kind of websites and said, how many metrics can you track? NBA.com had over 160. Major League Baseball, you could see they had over 150. You can see the numbers there. Huge. I'm sitting there thinking, okay, if I'm a coach and I'm trying to figure out what's important and someone sticks 160 metrics in front of my face and says, all right, here's all the details about the team. Figure out where we should focus. I'm probably going to toss that aside and focus on some basics or, ask somebody to distill it down for me because that's just information overload. And that's what somebody did. They went through and they analyzed the 160 metrics and they looked at basketball. So here's the list of just some metrics, right? Like I said, if somebody handed all these to me, it's kind of information overload. So if someone was to give that to me, it's like, is 3-pointers made important? Is steals important? Is points off turnover, right? What's important? And what they found when they did the study is they were able to boil it down to 4 key elements that had the biggest impact on winning. And there's something similar in your business. Maybe in a SaaS business, one of the biggest impacts is churn rate. Maybe in a service business, it's billable hours. Maybe you're in a business where gross margin is hugely important, or quick ratio. And so they found these four key elements that had the biggest impact on winning. And they were shoot a high field goal percentage, which is a term I've heard. It's a make or miss league, right? Make your shots. Don't commit turnovers, get rebounds, go to the foul line. So those were the 4 items. And from that, you can easily distill that down and say, okay, I can now see how my team performed. I can see how the opponent performed. And then I can start to come up with plans for players. And I have some key metrics at the top, and I can build metrics around that and goals and figure out how often I should measure things. So this is really important in every business, is understanding what impacts your results and understanding your business. And so we'll talk a little bit about that here more in a moment. But here's another example of just business metrics, just, big list, right? Percentage of market share, monthly website traffic, EBITDA margin, net profit margin, just a long list of them. And I love this picture on the right with this quote. It says, if you don't collect any metrics, you're flying blind. If you collect and focus on too many, they may be obstructing your field of view. So, right, none of us want to go into business with nothing, not tracking anything. But if we do too many, it obstructs our view. And so this picture really sums it up. You can see the lady here, her hands over her head. She's just like, okay, information overload, too much stuff. I got this coming at me, this, got this chart over here. I got my computer, and I can't take it all in. I don't know where to start. And so that's a challenge we all face. And what I like to think about is there's a rule called Miller's Law, if any of you have ever heard it. And what it is it was a psychology study that was done. So they did a study to see how much information someone can hold in their short-term memory at one time. And what they found is the average human can remember 7 things at once, plus or minus 2. So that kind of 5 to 9. And that's often why you hear people say, key metrics should be somewhere in that 5 to 10 range for a business, or key performance indicators, those KPIs, because that's something that people can relatively easy remember, which gets to this next slide here. And I just want to ask a question before we talk through this. If anyone's willing to just put in the chat, how many of you feel like you have a good handle on KPIs in your organization? If you feel like you have a good handle and you're measuring the right things, just throw a yes in there. If any of you are willing to, maybe a no, or maybe just give me a general idea if any of you are brave enough to respond here in the chat. Kind of, definitely, yes. All right, so we got a couple of yeses, not yet, but working on it. All righty, anyone else? Yes, yes. That's great. Seeing a lot of yeses, which is a really good sign. Nope, not enough people understand their usefulness. So that sounds like a little bit of a cultural challenge Michael is working on. Work in progress, working on it. So we got a little bit of everything, which is what I would expect. Too many, Miguel, yes. That's a real challenge, kind of 5 to 8 range. Okay, so making progress on it. So it sounds like we have a little bit of everything. But I'm really glad to see some companies feel like they have a good handle on it, and others are working on it. So what makes for a good KPI? And what I like about this list here is it's a couple things. It's not long. There's not a lot to it. The first is it's simple. If your employees cannot understand it and your business leaders, then you probably should not consider it a KPI, because it needs to be simple. You need to be able to explain it. If it's really complex, you need to rethink it. Next, as we've talked about, it has to be measurable. The third one there is critical. I think it's really, really important. It has to be actionable. Can you act on the KPI? Can you influence it? If you're tracking something that the business can influence, like maybe you're tracking interest rates, but you have no ability to change interest rates. That's probably not the right KPI to track. It doesn't mean it's important. It doesn't mean you can't track it as a metric, but it's really not a key performance indicator to your business that you want leaders to focus on, because you want it to be actionable and relevant. And yes, it could be relevant. Yes, it's measurable. Yes, it's simple, but it's not something your employees can influence, right? We can't go out and change the interest rate. And then last, and this is one that's often issue, is aligned, especially among the executive team. They got to be on the same page. You don't want every leader looking at different things. It doesn't mean they may not look at some other metrics for their business, but at that top level and at each level down, you want to be aligned on what you're tracking and what's really important. So when it comes to KPIs, this is according to Investopedia, and I've seen different lists out there and different ways to kind of slice and dice KPIs, but to talk about 4 major categories of KPIs. So first, you have your strategic KPIs. And the way to think of that, right, is your high level. Those are typically used by senior leadership, your C-level suite. Everybody in the company should know what those are. Then you may have some operational ones, which are measures over time, around performance. So sometimes strategic KPIs could be something as simple as revenue growth. They could be other things. And operational is maybe you're measuring the performance of your website over time. Like, what are your views to every day? An example of a functional one could be a call center. You're measuring the number of calls that come in today for that specific function within the company. And then the last group is leading and lagging indicators. And so a leading indicator, as many is something that comes in advance. So a net promoter score would often be a leading indicator that you might have churn. So if your net promoter score had been really high and all of a sudden it started to drop, odds are you're going to see churn and customer attrition follow that. That's a leading indicator. Most of our financial KPIs, there's a few that can help with leading, but they're mostly lagging indicators, right? It's already happened. It's after the fact. That's why we see flash and other things that we try to report before the numbers are finalized, to give a little bit more of that leading piece. And so these are the different categories. And so next, as we talk about finance KPIs, I want to take a minute and just talk about the importance of us as the business partners helping the business understand what's important. The reality is there's hundreds, if not thousands of metrics, right? If you Google metrics, you get 1.2 billion hits. If you Google financial KPIs, I want to say I ended up with, I think it was 118 million hits on Google, right? You can measure almost anything and come up with all kinds of ratios. So the first thing you really need to do is you need to be that strategic partner. Finance is no longer viewed as a back office function. FP&A, controller, finance is really there to help move the business forward and make sure every dollar spent is allocated efficiently. And so enable to helping the business choose the right KPI starts with really understanding your business and understanding what's important, because those KPIs will change depending on your industry. There are some key ones I think everybody should understand, and they're key metrics that we should track. But again, a metric does not always mean it's a KPI. In one business, it could be a KPI. In another, it might only be a metric. So really focus on what drives the business. Understand the key items. I remember in one business, the more I learned, we changed what we were tracking as I really started to understand what drove the economics of the business. And it took time because I supported a couple different businesses and we had a number of different units within them. So it was a relatively complex business model. But the better I understood it, the better I was able to really distill down and focus on what was important. And then one other thing I would add that can be very helpful is benchmarking against industry and your competitors. Not every company can do that, but in general, you should be able to find some industry and competitor data. A good example is if you're in the SaaS industry, your software as a service, rule of 40 is a general benchmark that anyone could track against. We won't get into detail about that metric, but that's an example of something you could benchmark against, margins, which we'll talk a little bit more about here in a minute. So what I want to show next is these are the KPI categories we're going to talk about. And you see there's 6 here. There's the margin KPIs, There's liquidity, efficiency. We'll talk a little bit about employee productivity, expense, and then top line or revenue KPIs. And I'm going to just take one moment here before we continue in the PowerPoint deck. And I'm going to show you the Excel file that everybody will receive as part of attending the webinar, and just show you what's in there for just one moment. Give me 1 second here. I thought I had it open. Let me just reopen it. Yeah, okay. So everybody should be seeing my Excel screen. So what's going to be in here, and we're going to talk about, these KPIs, but what you'll get is you get a file, has an instruction in it. It will show some of the common KPIs. It will show, the formulas for each of those. There's roughly 19. And then in here, you can see an example of them. So there's some financial metrics by year where it will show, hey, what's the gross profit margin? How do you calculate AP ratio? How do you calculate EBITDA margin? So show you how you calculate each of those. And it's done using a public financial statement from Microsoft. So that's in here. In addition to that, there's a couple of examples that are from a SaaS business around lifetime value of a customer, different ways of calculating customer churn, which tend to commonly be SaaS metrics, but is something you can calculate in many different businesses. So show you the formulas, you can see the math and the data. There's some employee productivity examples around how that works. And then some information here, we'll talk about this back in the deck in a minute, but some benchmark data. There is a guy by the name of Ashwath Damaran, who's at Stern, New York University, that every year he goes through and publishes like 15 or 20 key elements, benchmark data. It's really mostly around helping investors for every single industry has a public company in the US, or that's on the US stock exchanges. So many of them are global companies, and he goes through and he'll show what the gross margin is and the net margin. So that information's included. And then you can see the raw data that was used in all the calculations. So as I go through this exercise, just remember at the end, you'll get all the formulas. I'm not going to go in detail through formulas today or any of that. I think you'll see those in the article, and then you can also see it here in the Excel file. But I just wanted to give you you guys a little bit of an idea of what you'll be given so that you could see that. Oh, so sorry, let me try. I just saw someone said, please zoom in. So let me just show here one more time, a little closer. See if that helps. So what you're seeing here is this is industry, number of firms, gross margin, net margin. It's a benchmark, and it has over 100 different industries based on 2021 data. So it's updated annually. Here I mentioned there's some employee productivity numbers showing how you calculate it, really around a service business. And just each page here, you'll also be able to see the formulas are listed, so you can see, hey, what's the formula that was used, as well as the data. So hopefully everybody was able to see that. That helps. Thanks, Hugo, for mentioning that. And I'm going to switch back to the PowerPoint deck now. If there's any questions, feel free to throw those in the chat. All right, so we mentioned these different categories. So now we're going to go through and just talk about these different categories. So the first one here is margin KPIs. And I think every business should have at least, one margin KPI they're tracking. Sometimes it may be more than one is key, because really understanding your margins are essential. And I learned that lesson in high school. I still remember, it's one of the few things I remember. I had a business class my junior year of high school. I remember the teacher telling us he knew somebody who was running a business. They were selling wheelbarrows, and they were selling them really, really well. And the guy thought business was going great. He had generated a lot of revenue. Well, he hadn't been calculating all his cost of goods sold and his time spent in his product. He didn't understand his margins. And in this case, the person had been selling them at a loss. So he had a bunch of revenue, but he wasn't covering his expenses. And so, that's an extreme example, but that for me hit home of how critical it is to understand margins, right? You can benchmark those against industry. You can compare them over time. You compare them to prior period, budget, and forecast. Gross margin is your revenue minus COGS. And that might be, hugely important in a business with high cost of goods sold, but not a lot of expenses after that. Like I'm working on a project right now with a company where 90% of their expenses are cost of goods sold, and they have relatively low people cost after that. So, one of the closest things they look at is their gross profit margin, because it's the biggest indicator of what their net profit margin will be. Well, other businesses may have almost no COGS, and so may be very focused on net profit. EBITDA, right? That's a term everybody's familiar with. I like to call it earnings before I trick the dumb auditor. Most people call it earnings before interest, taxes, depreciation, and amortization. And I've seen a few others, a lot of people like to have fun with that, but that's a very common measure for any PE or venture capital business. If any of you are in that environment, you probably track that regularly, because many businesses are bought and sold on a multiple of EBITDA. So here's just kind of an example. What I like is, this goes back to the Excel file you'll get, is showing how different margins can be, why it's so important to understand your industry and how it will vary year to year. So let's take bank. I was surprised by this. Money Center, there's 7 firms. Gross margins is 100%, right? If I have no cost of goods sold, don't really need to track it, right? Net margin is going to be important. Where if I come down here and look at, this is the second page here, and come look at software, right? What I see here is I have a gross margin of 61%. All right, so, fairly healthy growth margin, but my net margin is negative. So it's costing me a lot to get the customers, is more than likely, which is pretty common in software. So I might be tracking both of those as key indicators in that business. In other businesses, I may be very heavily focused on just gross margin. Air transport was 98% the other year. And this was 2021, so I'm sure there was some COVID impact in some of these numbers compared to a normal year. And those are things you'd want to know. So that's margins. And like I said, what you're going to track is going to depend on your business. And you'll hear me say that again and again as we go through each of these different categories. That's where it's key to be that strategic partner, to understand your business, to understand the metrics, and to know when to use different metrics as a KPI based on the strategy and the goals of the business. So liquidity KPIs, right? Most of us know what those are. Measures ability to meet short-term obligations. Nothing surprising there. Often used to help determine creditworthiness. And so which one you'll use will vary. Again, we have net working capital here. We have working capital, the current ratio, and the quick ratio. And each of those will be used in different situations. So, businesses that are in financial distress or heavily levered may be focusing extremely closely on working capital. A couple days improvement there can ensure they have the money to pay their debt. Yeah, the webinar recording will be made available, Sandra, and there will be an opportunity to get the Excel file. So yes, there's also the article. So information will be provided. So I think that answers the question I'm seeing there. All right, so just going back, when you look at current and quick ratio, the quick ratio might be used in a company that has a lot of inventory, right? Because you don't want to include inventory in your calculation, because generally inventory is not something you can quickly sell and liquefy to pay a bill. So, right, if I'm a grocery store, I have huge inventory, or if I'm a retail store like a Best Buy or a clothing store, Nordstrom, whoever it might be, you're going to look at a different ratio than a software business. So also when it comes to working capital, I mentioned the distress situation. The other area, any of you, if you work for kind of a VC-backed company right now, you're obviously probably in a hyper growth mode. If you're an early stage company, seed, Series A, Series B, and working capital is critical, especially in the current economic environment, as we've started to see a downturn and there's concerns that we're either in a recession or a recession's coming, and there's not as great willingness to fund these companies. You need a longer runway. And working capital is something you have to watch extremely close, along with other measures, your burn rate or whatever it might be. So here's just a simple example. And this is what I like to show this, because it shows the importance of understanding industry being able to put the numbers in context. So, if I just look at a quick ratio for April, I can be like, all right, I'm 2.9 and 2.5, looks good. I look at it over time and I notice it's been declining. So, all right, so that's concern. My quick ratios declined, my current ratios declined. But then when I look at it compared to industry, what I see is industry is also declined, and there's a big drop in both from July to August. So knowing and being able to have that industry information may help me realize that, I need to look at the external environment. I need to go out and look around me and see what's going on. And maybe there's something that's happened in the external environment, a recession, whatever, that's changed our ratio. Reason we borrowed, more cash, and so we have more liabilities or we have less assets. And so again, being able to look at the industry in addition to our company's ratio is really helpful in understanding something like that. So that's just a simple example under liquidity. So we've talked about the first two. We've talked a little bit about margins and liquidity. The next one that I recommend, every finance person should know is efficiency KPIs. And these are tied closely in many cases to liquidity. But what you're going to see here, as we mentioned, 4 day sales outstanding, accounts receivable turnover ratio, accounts payable turnover ratio, and your inventory turnover ratio. And so, these are things that tell you how efficient your business is. So, day sales outstanding, if you're in a business doesn't issue on credit or doesn't allow people to pay over time, AR and DSO really isn't very important. But if you're a business that extends long-term credit or allows people to pay on credit cards or pay installment, or people are paying you monthly, that becomes really important. How long is it taking for people to pay me? How often do I turn it over, right? Am I efficient in collecting my payments? And then the next one is AP ratio, right? Are you efficient in how you pay your customers? If all your customers give you net 60 and you're paying them in, 15 days, you probably have a problem. Or if all your customers are offering you a 2% discount, but yet you're not taking advantage of it. So understanding your AP ratio and understanding payment terms allows you to maximize your cash to invest, which is just being responsible as a finance professional. And then finally, inventory turnover, right? Again, very important in retail, not so important in SaaS businesses. And so that's, again, where it gets back to understanding your business to know which of these metrics are most relevant and important to track. And again, just another simple example, very similar to the last one. But in this case, I showed some competitors. Sometimes understanding competitor data can give you a different view, a different understanding than just looking at industry and yourself. So what we see here is days sales outstanding has been creeping up a little bit, pretty much almost exactly in line with industry. But when we start looking at competitors, we see competitor A is doing something very different, right? They're collecting in about half the time of everybody else, the days sales outstanding. So question would be why, right? That might trigger you to go, are we doing something inefficient? Yes, we're much better than competitor C. We're in line roughly with competitor B, but what's going on with competitor A? And does it help us understand changes we can make to drive that metric? And again, this could be done for many industries. You could get this data from, public companies. So if I work in, like when I worked for American Express, I worked in the prepaid business, and I can remember going out and reading, it was a company called Green Dot, reading their financials to understand some of their metrics, right? If I operate in the cloud industry, I could look at, Microsoft and see what they tell about the cloud business, and AWS and, whoever else, the retail industry. I could look at, Walmart versus Target versus, Costco, whoever it might be. You can get some of that information and benchmark yourself. It's often available through many different services. So next, I want to talk a little bit of employee productivity KPIs. And this isn't like productivity in sense like tracking keystrokes or things like this. This is actually software that Beebole offers. Is they're a time tracking tool. And a couple ratios here we'll talk a little bit about is billable hours and project utilization. And as we've emphasized before, these can be industry specific. But what I love here in this graph is a really simple graph that really drives home what would be a KPI for a service industry. And when we speak of service industries, there was a great article written by Ken Fick as a run-up to this webinar, where he talked about some of the key metrics that he likes to look at in service businesses. So he's often worked in with consulting firms. So this is a great example. If I'm a consulting firm, billable hours are really, really important, right? If I'm working in a warehouse, not so important. So what you're going to see here is you see 80%, you see it trends up to almost 90% in May. You see it by week, and then all of a sudden it drops down to 50, comes back up to 70. So I can quickly see from this, I can see that this is simple, it's measurable, it's actionable, it's relevant to the bottom line. The higher these numbers, the more profit we earn, because the more we're able to bill to a customer. And so what I can simply do is I can go and say, okay, what happened in June? And you can drill into that and figure out, okay, people are on vacation, or we let go of a consultant, or somebody's on the bench. Well, why are they on the bench? Why aren't they working, and how can we change it? So this graph, this is one from the time tracking software from our sponsor here, who did the webinar, and just kind of gives you an idea of, one easy way to track something. This is another one, employee, productivity. So this could be projects. For example, maybe you're tracking, here you have security portal, rebranding, these names of different products. And what that helps you understand is how much time is being spent on each product and is our focus in the right area. If we have a key project, like, maybe this fiber extension infrastructure is key to the health of the business, I can look and see, okay, is the right amount of time being spent? And it looks like, okay, there's a couple weeks. Why haven't we spent more time on it in the other weeks? And management can quickly look at it, and you can make those necessary adjustments if you need to make them. So next, we have expense and top line KPIs. And so within expense KPIs at the highest level, some really simple ones to track and understand are really ratios. And I love ratios because they allow you to track over time, easily to compare to other businesses, right? It's hard to take an R&D number, $1 million, and compare two companies that are very different. But when I can see a percentage of revenue, it's a ratio. I can look at it and say, okay, they're roughly the same percentage, even though the numbers are very different. So we have three ratios here: sales and marketing, G&A, our general administrative, and R&D, research and development. And so I have an example of a company here, and what you'll see is the R&D has been going up over time. The sales has also been going up slightly. But what you're going to see is it's much lower compared to industry. So if I was to look at this, R&D might be something I'm tracking very closely, because I know we're a product-led organization, which means we lean in heavily into R&D, and we spend a little bit on sales and marketing. And then you can see G&A is growing, and there could be a question why, right? It could flag that there's a concern. And then lastly, I have OpEx as a percentage of revenue. So there's a couple different ways you can track this. Here, I'm showing it against an industry. You could track it year over year. You can track it against a budget target. But understanding these ratios are really helpful because it allows you to normalize. And then you drill down and focus on what is important. What's really that metric that matters for your business? Is it sales and marketing that's critical? Generally G&A is always important. And are we in the right range? Should our G&A be 5% of revenue? And so, okay, we got a problem. Maybe we need to do a restructuring. Or is it growing because we're a very small business and we've had to hire a new leadership? And so we see a big increase until the sales grow and it will come back in line, right? That's where context and being a smart business partner and understanding the business helps drive which KPIs you select. And so then the next one here I want to do is just top line revenue, right? This is the one everybody loves to focus on. Revenue is sexy, right? Growth is sexy. Everybody loves to see, hey, we doubled our business. We went from, 100 million to 200 million, 200 to 400. M&A, the number one reason businesses go out and buy another business is they want to buy growth. They want to grow. Most of those acquisitions fell. So this revenue growth is important, but it's important in context. It's a very easy measure to track, and every business should be tracking it. And it's probably going to be one of your key financial metrics in virtually every business. I can think of one exception. For a while, I supported traveler's checks, and this was in 2016, right? The amount of revenue we generated, yeah, we tracked it, but what was more important is how many of the checks were getting in cash that people had bought 5-10 years ago. So, right, we would have loved to double the business, but we knew that wasn't the environment we're in. So it was more important to understand and the liability we might have in the future. So different businesses will track this different ways. Next, customer churn, right? And customer lifetime value. If you're in any business that has repeat customers, not just SaaS, not just software, you should be understanding your customer churn. And I'll give an example. I was working in a SaaS business at the time, and we'd had some product issues, and we lost a bunch of customers, and the business wasn't really aware that they were going to see a bunch of cancellations and how high it was. And so I went through and created a report, and I sent it to the general manager daily, showing him every customer that had canceled, what was in the pipeline, what might potentially cancel. Then we went to the point where we had weekly meetings, and I shared those with our directors of our account management team and went through every account to see what they were doing to save those accounts. And that focus, we made that a key performance indicator. That was a key metric we were tracking, helped to reduce our customer churn because we made it a huge focus of the business. So that's an example where, it wasn't always a key metric they'd been tracking, but when we had those customer problems and the market became more competitive, we really, started focusing in on customer churn. And then last is customer lifetime value. Right? This is a huge one. Everybody that has repeat customers should understand how much value is that customer, how much can I spend to acquire that customer? How much can I spend to service that customer? Because if they're going to keep coming back, you're going to be willing to spend more those first few times, to do more to make sure you keep that customer. So, understanding which of these are, most important and which ones you should track for your business is key. And so just wrap up, and then I want to give, 10, 15 minutes here for some questions for people to ask. Is in conclusion, right, it starts with having a data-driven culture. If you don't have a culture that's focused on making decisions based on data, think about how you can make that change, how you can lead it, how you can get leadership involved. Next, remember, you're going to have to measure, but you don't want to measure everything. You need to focus on what's important. I said, focus on key business drivers, those key indicators, no more than 5 to 10 KPIs. Some cases at the company level, it might be 3, right? Like I mentioned the example of weight loss. I said, probably 2 things I'm going to most track. How active am I? How often am I exercising? How many calories am I burning? And how many calories am I putting in? What's my diet? And are those calories the right calories? If I'm focusing on those 2 things, for most people, that's going to be effective. And so, common categories exist, but remember metric selection, again, it varies by industry. The title was KPIs every finance professional should master. We should understand these metrics, but just as, if not more important, we should understand how they impact our business and how we ensure that we're selecting those metrics that are most important. And then finally, when possible, make sure you benchmark against industry and your peers. Take the time to see how you compare to others. Benchmarking is a great way to measure your performance. And so we're going to go ahead and open it up here for a few minutes for Q&A to give you guys an opportunity to ask questions. I know people responded differently, saying, some feel they're in a great shape. Some feel like they have a lot of progress in their work and they need to, improve on measuring KPIs or figuring out the right things to measure. So feel free to go ahead and ask any questions that you have at this point. We want to leave some time at the end to let you guys ask questions. Great question. So nonprofit KPIs, Any recommendations or best practice? That's a great question, Katie. And I would think, around that, the type of things that would probably be key to track is one, how many donors you have, how much you're donating, maybe grants. So it's the cash coming in to fund the business. And then what are the key projects and what of that money can I spend toward those projects? Like I know I had a conversation with somebody who was actually creating a software specifically designed around helping, manage and budget for KPIs. So I think for nonprofits specifically, it was really kind of an interesting thing. So those are the couple areas that come to mind. But again, I think the principles are the same. Do you have data? Can you measure it? What's actionable and what's important? What, strategically, what are you focused on as a nonprofit? And I'll give an example. It's not a nonprofit, but it's a Corp B company called Cotopaxi that focuses, and there's many Corp Bs, Ben's and Jerry's and others, but they focus on alleviating poverty. So one of their KPIs is what they've done during the year to alleviate that. They track those. They show you how much money they've spent, what initiatives, what they've done with each initiative, and that's key to their culture and their business. Please suggest 5 KPIs for the manufacturing industry. So I don't have 5 right here off the top of my head. I know of a list of 10 that somebody recently shared on LinkedIn that's worked quite a bit in the manufacturing industry. So I'm actually going to refer you to that list, and you're welcome to email me and I can find it for you. But Satish, if you go and look up Nicholas Boucher, there was a very long and healthy discussion on LinkedIn around manufacturing KPIs. So instead of going through a list here, I would recommend you take a look at that. And then if you have further questions, you can reach out to me. And then let's see, what do we have next? How do we get to know which are the more appropriate KPIs for an organization? So great question, Minnie, there. I think the key to that question is understanding the business and where it's at. The better you understand the business, the better you understand, strategy and leadership and what they're focused on, the easier it is to understand which KPIs are most important. A good example is that customer churn. By knowing what was going on in the business, I knew at that point that was critical. So we tracked it very closely. If I'm in a business that's a turnaround and I have heavy debt, really understanding my liquidity could be the number one thing. Where if I'm a very mature industry with no debt, I'm probably not as concerned about my liquidity ratios, especially if I don't, extend on credit. So it really comes down to understanding your business, talking with your leaders, talking with your partners to know which ones are most important. Actually, it's a new startup, biodiesel industry. Yeah, I'm not familiar with the biodiesel, so I'm not going to be able to give you, which would be your most important KPIs. Obviously, you have your financial ones and you can track some of them here, but I think it's talking with your business partners there. All right, so we have a few others. All right, so KPIs and accurate consolidated data seems like a chicken and egg situation. Which one would you suggest comes first? Well, accurate data is very subjective, right? There's no such thing as perfect data. And if you're waiting for perfect data, it's never going to happen. Now, you do need directionally correct data, and you can improve it over time. So I think if your data isn't even directionally correct, if it's a total mess, you do need to get it to some level of usefulness. But as long as you have useful data, which most companies do, maybe some startups that have been doing everything on a cash instead of an accrual basis, it's going to be really hard to understand finance. And so what I recommend there is you clean it up first. But outside of that, at least select a couple KPIs and then put some to the side that say, okay, this is a great KPI, but we can't measure it yet. So what do we do to get there? And just work through it one at a time. It's like any process. There's a saying I really like that I learned as a kid. How do you eat an elephant? It's one of my favorite sayings. It was one bite at a time. And that's really how you have to approach KPIs and your data. You start with what's most important and work through it. Measure what you can today, Put at the side of what you want to measure tomorrow and how you're going to get there. What processes or tools do you determine which of these KPIs are most important for a particular company? So, again, I think what process do you use? For me, it comes down to, like I said, understanding the business. So if I'm in a venture capital firm or I'm in a SaaS industry, I'm probably going to look at some SaaS financial metrics. If I'm in, a mature industry, as I mentioned, I'm going to look at some different metrics. So I can't give a clear answer and say, hey, for each one of these, do this. Private equity is often EBITDA. Any kind of heavy inventory, you're probably going to look at inventory turnover. If you do a lot of sales, AR is going to be important. So really, what I recommend is you go through each of the 6 categories. You look at what's important to your business, what really drives results, and just try selecting one. So I'd recommend, if you're lost as to where to go, how to do it, that's how I would do it, is go through and go margin, liquidity, efficiency, employee, expense, revenue, and look at each of them and say, okay, which one is going to help the business most? Which aligns to our strategy? And which one, if I track and are we actually able to influence and drive the business forward? So that's what I'll say on that one. Thank you for the question there, Anthony. Always leads to Rome, they say, but can a single KPI have more than one formula to calculate it? Yes, Elena, they can. SaaS metrics is a great example. ARR, I've seen different ways. I've seen CAC ratios calculated different ways. Customer lifetime value. Some people will use gross profit. Some people might use EBITDA margin. I gave common formulas in the Excel file. One thing that's really important, and we didn't talk about this with KPIs, but I've talked about this before in other cases, is agreeing as a business how you should calculate things. That's where it gets to that one source of truth, right? Because if you don't have that, you get into a meeting and it ends up going to that, well, how did you calculate this? And as soon as a meeting goes into how did you calculate it in a question of assumptions, nothing gets accomplished. You've lost the team and the trust. Which KPIs are used for measuring human capital risk? So when we say human capital, I'm assuming you mean like employees leaving. So I think employee satisfaction is a common one. You can also look at how often you reward employees, training, how often they're attending training based on your culture. So there's a number of, different things you can look at, but that filters, first to senior leadership. Do people understand the vision and mission? Are they engaged? And how do you track those? Employee surveys is a common way. How often are you doing those? All the way down to the individual manager. And are they having one-to-ones? Are they understanding where there's employees at and making sure they understand performance? So I think, when it comes to human capital, it starts at the top, but there's things all the way through that you can do to help manage and ensure the employees are happy. And I think we've covered everybody's questions as best I can tell. Give it one more minute here, see if any others come through. I've missed any. All right. Well, we're just coming up to the top of the hour. So I'm not seeing any questions come through. I want to first just thank everybody for attending. I appreciate you taking some time out of your day. I know everybody's extremely busy. Next, I want to thank, Beebole. I want to thank DataRels and Persona for putting this together, giving me the opportunity to speak to you today. And the Excel file will be sent. The webinar will be made available. The article that talks about every one of these metrics and different use cases for them will be made available to everybody. And you're always welcome to reach out to me if you have any questions. So thank you, everybody. I really appreciate you taking some time and joining me today. So thanks again for your time.